Welcome back to the Deep Dive. Today, we're taking a high-speed, targeted look at a really big one. The Q4 fiscal year 2025 earnings conference call for the Walt Disney Company. This call, it happened pre-market on November 13th, and it felt like a major checkpoint for the entire media sector.
Right. And our job today is really to bypass the prepared remarks and the corporate cheerleading. We need to focus on two things for you. First, which parts of the business are actually carrying the growth now?
And second, why did the market completely panic, sending the stock down nearly 10%?
Exactly, especially when management was out there touting this massive strategic victory.
Okay, let's jump right into the financial snapshot, because I think this is where all the confusion really began. We had a clear earnings beat, but then a revenue miss. And that's a deep disconnect.
It really is.
The non-GAAP diluted EPS came in at $1.11. That soundly topped the $1.05 consensus.
Which is a solid beat, about 6%. Investors are supposed to love that.
They're supposed to love it.
They love the earnings per share beat, but they absolutely hate the top line miss. Q4 revenue was $22.46 billion.
Just flat.
Essentially flat, yeah. Down about 0.5% year over year, and it failed to meet what the street was looking for, which was closer to $22.8 billion. So the market's immediate read-through was just simple. The engines might be profitable, but they are not accelerating fast enough. Not enough to overcome the legacy drag.
And you could tell management was really trying to anchor the story on the full year success. They kept pointing out that fiscal 2025 adjusted EPS was up a very strong 19% year over year.
It is strong momentum, but Wall Street, it often focuses on that quarter over quarter trend as a signal for what's next. And that flat Q4 revenue just screams structural weakness. It implies the old cash cows are deteriorating faster than the new digital businesses can scale up.
And that skepticism just instantly translated into selling pressure.
Big institutional selling pressure.
So let's pivot to those new engines, because this is where the management team put all their enthusiasm, and you can see why. The first engine is experiences. That's parks, cruises, and consumer products. I mean, this segment is Disney's rock star right now.
Oh, absolutely. Experiences delivered record operating income for both the quarter and the full year. We're talking Q4 revenue growth of 6% to almost $8.8 billion, and operating income jumping 13%.
And what's interesting there is the visibility they have.
The visibility is fantastic. Bookings are already up 3% for the first quarter, and they're just relentlessly expanding. You've got new cruise ships, the Disney Destiny, the Disney Adventure. There's even a new theme park planned for Abu Dhabi. This segment is the high-margin, reliable cushion that supports the whole restructuring.
Okay, so that's engine one. Engine two, and this is arguably the most critical one, is streaming. Direct-to-consumer. Management called this a massive turning point.
It really was. They reported that DTC achieved $1.3 billion in operating income for the full year.
And you have to put that in context for people.
No.
Just 3 years ago, that same segment was bleeding $4 billion a year.
It's an incredible turnaround. I think that's the real insight from the entire call. Disney proved DTC profitability is actually achievable.
They shifted from the volume game to the value game.
Exactly. Q4 DTC revenue was up 8%. Operating income shot up 39% year over year. And combined subs for Disney Plus and Hulu hit about 196 million, which beat their own expectations.
So the price hikes are working.
The price hikes and cost controls are absolutely bearing fruit. It signals sustainable growth, not just chasing subscribers.
Okay, so that sounds like a huge success.
Yeah.
So why did the market just ignore it?
Because every time management highlights a success story, the shadow of the entertainment segment just falls right over it. That is the primary drag.
It's the foundational problem, isn't it?
It cannot be wished away. Entertainment, so linear TV, film content saw its operating income fall 35% in Q4.
35%.
And the driver is the terminal decline in linear TV advertising revenue. That is the structural headwind they're trying to outrun.
And management mentioned softer film performance. They named the Fantastic Four and Tron airs. But that feels symptomatic, not the root cause.
It is. The root cause is that shrinking broadcast footprint. The film slate needs to deliver, for sure, but the core issue is the erosion of the legacy networks. And even mighty ESPN is struggling with margins. Operating income was down 2% in the quarter.
Even with viewership up.
That's the crazy part. Viewership is robust. Ratings are up 25% across the networks. But the cost of sports rights is it's astronomical. It is a huge, expensive beast to feed.
So we've established the legacy drag, which begs the question, how does management plan to outrun it? And that brings us to the strategic roadmap.
Which is all about integration. The DTC strategy is focused on building what they keep calling a unified app experience.
Right, with Hulu basically becoming the general entertainment brand inside of Disney Plus.
Exactly. Simplify the journey for the user, unlock the value of the bundle. The goal is to push streaming margins much, much higher over the next few years.
And this applies to ESPN as well. Management called the launch of ESPN's full direct-to-consumer service a big success.
A huge success. And here is the critical data point they shared, the one that really matters for churn and stability. 80%. 80% of new ESPN subscribers are taking the Trio bundle. That's Disney Plus, Hulu, and ESPN all together.
Wow. And the reason that's so healthy is what? Stickiness.
It's content stickiness. If you have those three distinct pillars, family, general entertainment, and live sports canceling means losing all three. That dramatically increases the perceived cost of churn for you, the consumer. You just don't want to lose it all.
They also talked about pushing hard on innovation. Things like generative AI.
Yeah, plans to use AI for better personalization, maybe some e-commerce inside Disney Plus Seat. They're even exploring ways for subscribers to create their own short-form content, while, of course, protecting their IP very, very strictly.
And to back all this up, they announced a seriously enhanced capital return program.
A big one, designed to reassure shareholders. The board approved a 50% dividend increase to $1.50 per share.
But the real signal for the big institutions was the buyback plan.
Oh, yeah. They're targeting $7 billion in share repurchases for fiscal year 2026. That's double the $3.5 billion they just bought back.
That aggressive spending is backed up by some very confident financial targets.
Extremely confident. Management reiterated they're targeting double-digit adjusted EPS growth for both FY26 and FY27. And they were clear this growth is supposed to come from operating leverage and DTC revenue growth, not just more cost cutting.
They really believe the content slate is going to deliver. They specifically name-dropped Zootopia 2, Avatar, Fire and Ash, Toy Story 5, and Avengers Doomsday.
So you have this incredibly strong long-term guidance, a huge buyback commitment, which brings us back to the big question, why did the stock collapse?
Let's look at that investor context. The selling wasn't passive. I mean, institutional investors were sprinting for the exits.
They were. The stock closed down 7.8% on the day of the call, and it extended to a nearly 9.3% drop over 2 days. And the equity volume just spiked. Around 44 million shares traded. That's 4 to 5 times the recent daily average. That is heavy, concerted, institutional repositioning.
The market just read the flat revenue and said, this is a near-term problem that streaming can't fix yet.
That's the read. But what's so fascinating is if you look at the options market, you saw this true two-way battle, a real tension. You saw aggressive downside hedging, investors buying bearish puts, but that was running right alongside substantial accumulation of long-dated call spreads.
So people betting on both sides.
But on different timelines. The calls were for January 26 and January 27 expiries.
So that's smart money basically signaling, I'm cautious about the next few months, but I'm willing to bet on a recovery in a year or two.
You nailed it. Short-term caution, focused on that linear drag, but retaining that medium-term optionality. It perfectly reflects the core tension of this whole story.
And now it is time for our segment. This is not financial advice. We dive into an outrageous but plausible trade idea based purely on the data and the volatility from this earnings call.
And given that extreme divergence between management's confidence and the market skepticism, the timelines here really suggest a tactical short-long pair trade.
Okay, a pair trade. It centers on managing the calendar, you said.
That's right. So management kind of signaled that Q1 of FY26 would have some tough comps. So the idea is you tactically short the stock into that quarter. You're betting that linear weakness persists, macro fears dominate the news, and that drives a little more near-term pressure on the stock.
Okay, so that's the short leg. What about the long side?
You'd use the proceeds or, the profits from that tactical short to fund the purchase of deep, long-dated, out-of-the-money call options.
How far out?
We'd suggest Jan 27 expiries, centered around, say, the $120 to $130 strike price.
So it's a conviction bet on the 2-year turnaround story. You're betting on the streaming execution, the operating leverage, and them actually deploying that full $7 billion buyback.
Exactly. It's a pure volatility play on a 2-year recovery thesis.
So to wrap this all up, this quarter was noisy, but it was also really pivotal.
It absolutely was. It proved unequivocally that DTC profitability is here. But it also harshly illuminated that persistent, costly drag from the legacy linear networks.
This feels like the turning point. where the future and the past just violently collided.
That's a great way to put it.
All right, here's the final thought we want to leave you with. The core tension is this, is that newly announced $7 billion share repurchase program sufficient to absorb the near-term selling pressure? Or does the market require unambiguous proof like a major box office turnaround before they believe this narrative is truly fixed?
It's going to be a fascinating battle between financial engineering and operational execution.
Thanks for diving in with us. We'll see you next time.